welcome to this edition of Reading the Tea Leaves. I'm Chris Zand, Managing Director of Private Client at Osterweis Capital Management, and this series focuses on recent developments in the financial markets. In the last couple weeks, we've seen a rotation out of software stocks, and today we're going to be speaking with several portfolio managers at Osterweis to understand their take on what's happening. Joining me today will be Greg Hermanski, Jasmine Shen, and Carl Kaufman, and we'll be discussing the implications of the sell-off, which truly has been significant. So with that, let's get started. Greg, can you give us a quick recap of what's been happening in the software sector?
Sure. The sell-off in software began in late December and really accelerated over the last couple of weeks. The catalyst has been a wave of new AI product launches, notably Cowork from Anthropic and OpenClaw, an open-sourced personal AI agent. Investors are growing concerned that these AI tools are increasing the pace of innovation and reducing the moat that entrenched software companies enjoy. That fear has triggered what's been a fairly indiscriminate selling across the sector. IGV, the software sector ETF, is now down over 23% year to date.
Fascinating. Thanks, Greg. Jasmine, I'd like to turn to you next. What's your take on how the market's responding to these developments?
We think some of the concerns are legitimate. The lack of revenue acceleration, even at the most established companies with massive install bases, shows that no one is immune to seat-based disruption risk. When AI can spin up functional software tools in a matter of days, the competitive modes that incumbents relied on for years are getting meaningfully narrower. In addition, even though large software companies have been rolling out their own AI agents and tools, the revenue from those offerings have not ramped as quickly as investors have hoped. These companies face a very difficult transition, giving up profitable, predictable seat-based subscription revenue and switching to consumption-based or value-based pricing models. The traditional software business model is being challenged in a fundamental way. That said, while valuation derating is warranted in some cases, we do think the market has gotten ahead of itself at this stage. Investors are throwing out the baby with the bathwater.
Thank you, Jasmine. Greg, I'd like to come back to you. Can you talk a bit about how we're responding and adjusting portfolios given these developments?
Of course, Chris. We think a selective approach is essential right now. So we've been reducing exposure to companies that we view as most vulnerable to AI disruption, while at the same time maintaining positions in software companies with moats that we believe are both least prone to AI displacement and could eventually emerge as AI beneficiaries on the other side of this. We're actively monitoring the landscape and we're evaluating new AI product launches for their implications on the companies that we follow. Now, frankly, some of these AI impacted stocks seem to be clearly oversold, but uncertainty is likely to put these stocks in a holding pattern for a period of time.
Thanks, Greg. Very helpful. Let's turn to Carl Kaufman next. Carl covers the fixed income sector. So, Carl, maybe you could talk for a minute about how these developments are affecting the fixed income markets.
It hasn't had as much of an effect on the high yield market as a whole, but we have seen a few isolated cases where spreads have widened, like Oracle, which is an investment grade, where people are worried about their massive spending. And a few other high yield names have been tossed in as well as investors tried to lower their weightings to the sector. We have a pretty small software exposure in our portfolios. However, private credit and leveraged loans are much more heavily exposed to software companies, so there's been more weakness there. We could see more material weakness there as prices are reflecting the fall in software stocks, but we'll have to wait and see. There clearly will be winners and losers over time, and eventually it will be more evident in companies' financial results whether these fears were overblown or not.
Thank you, Carl. And that concludes our update on recent developments with software stocks. And thank you all for watching, and I'd like to thank our portfolio managers for providing their perspectives. If you'd like to learn more, please visit us at osterweisprivateclient.com. Thank you.